Imagine a company so powerful, so dominant, that Wall Street called it the most innovative business in America. By the year 2000, Enron was worth over $60 billion. Its executives were treated like rock stars. Its stock price seemed immune to gravity. But beneath the shiny corporate towers and soaring profits lied one of the most elaborate, ruthless lies in financial history. This is the story of how Enron went from America's darling to absolute zero. To understand the crash, you first have to understand the genius and the arrogance of how Enron operated. Enron started as a traditional natural gas pipeline company. But everything changed when a man named Jeffrey Skilling joined the firm. Skilling convinced the government to treat natural gas like a tradable commodity, just like stocks or bonds. Suddenly, Enron wasn't just shipping gas through pipes. They were betting on it. They were financial traders. And for a while, it worked. In fact, it worked so well that Enron wanted to trade everything: electricity, broadband internet, even the weather. So, how did a trading powerhouse fake billions of dollars? It came down to a clever accounting trick called mark-to-market accounting. Under normal accounting, a company records profit when the money actually comes in. But with mark-to-market, Enron was allowed to estimate the future profits of a deal on the very day the contract was signed. Think about that. If Enron signed a contract that might make them $100 million over 20 years, they could legally log $100 million of profit today. And what happened if those estimated profits never materialized? Well, that's where the dark side of Enron came in. Enter Andrew Fastow, Enron's chief financial officer. Fastow created a hidden, intricate web of off-the-books companies. They had bizarre names like Chewco, LJM, and Raptor. Whenever Enron lost millions on a bad business deal, Fastow would secretly transfer those toxic assets into one of these dummy companies. To the public and to the stock market, Enron looked wildly profitable. But in reality, the debt didn't vanish. It was just swept under a giant, invisible rug. Fastow was essentially using Enron's own stock to guarantee these phantom partnerships, hiding billions in debt while enriching himself with tens of millions in secret kickbacks. By early 2001, the illusion was beginning to crack. Enron's massive bets on broadband internet were failing miserably. The dot-com bubble had burst, and the market was cooling down. Inside the company, a few brave employees started looking at the actual numbers. One senior executive, Sharon Watkins, wrote a now-famous memo directly to CEO Kenneth Lay. Her warning was simple and terrifying. "I am incredibly nervous that we will implode in a wave of accounting scandals." She was right. In August of 2001, Jeffrey Skilling abruptly resigned as CEO, citing personal reasons. Red flags immediately went off across Wall Street. Financial journalists started asking tough questions that Enron couldn't answer. By October, the Securities and Exchange Commission opened a formal investigation into Enron's secret partnerships. The dam broke. Fastow was fired. The company was forced to rewrite years of financial statements, wiping out nearly $600 million in reported profits and revealing over $1 billion in hidden debt. Panic set in. Enron stock, which had peaked at $90 a share, began a catastrophic death spiral. $80, $50, $10. Within weeks, it was trading for mere pennies. On December 2, 2001, Enron filed for Chapter 11 bankruptcy. At the time, it was the largest corporate failure in United States history. The human cost was devastating. Over 20,000 employees lost their jobs overnight. But even worse, most of their retirement savings were tied up in Enron stock. Thousands of hardworking people lost their entire life savings in a matter of days. Meanwhile, top executives had quietly cashed out hundreds of millions of dollars in stock right before the collapse. The legal reckoning was swift. Andrew Fastow cooperated with prosecutors and was sentenced to prison. Jeffrey Skilling was convicted of multiple counts of fraud and conspiracy, receiving a 24-year sentence. Kenneth Lay was also convicted, but passed away before his sentencing. The Enron scandal changed the business world forever. It led to sweeping new federal laws, like the Sarbanes-Oxley Act, creating strict rules to hold corporate leaders accountable. Enron proved that no matter how big, rich, or innovative a company seems, a house built on cards and lies will always come crashing down.